Hello, hello, my good people. This is CPA Edwin OCHOI. So for today, this is a session I'm going to talk about what you did in the RAST examination, which just ended the other day. That is May 2021 sitting. So we are going to talk about the financial reporting paper. So what was tested in that paper and how you are supposed to tackle some of the questions in that paper. So for you to gain more, because I will be tackling many questions for that sittings for even other papers, keep subscribing and keep pressing the notification key so that you will be notified once I upload the videos for the coming questions. So remember that financial reporting paper is a very easy paper tested by Kasneb, that is according to section 3 CPA. So last sitting, they tested a question of banking, that is how to prepare financial statements of various institutions. So one of the institutions is a bank. So they tested on how you are supposed to prepare the statements of a bank. So on that question of banking, it was just a direct question. It was a very direct question because you are supposed just to classify or to prepare the statements as required. So this was the question. So banking, that is May 2021. So it was just a question whereby you were told to do an income statement and statement of financial position. So remember that when we talk about statement of that is income statement, or they call it profit or loss account for the year ended at 1st December 2020. So it's just all about classification of incomes and expenses. But when we talk about banking, remember that we have incomes which attract interest and some expenses which attract interest. And we have some expenses which does not attract interest and some incomes which does not attract interest. So you are supposed just to classify interest expense, you talk about interest income, non-interest income, non-interest expense. And that's all. You are done with the income statement. Then for the statement of financial position, you are supposed to do just a classification again of the assets without mentioning long term or short term. So under banking, we don't talk about non-current assets or current. You just record all the assets together. Then you talk about equity and liabilities. So for equity, you just classify them. Then liabilities, you just mention them. And that's all you are done with that question. Then there was a question of group accounting here. It was again a very easy question. So anyway, before we move to the group accounting, let us look on this question of banking. Then I will move to the group accounting if time will be on our side. So before I go to the deeper side of that question, we need to go through some short notes here. I think those notes can assist you to understand more about the banking. So banking is a topic under financial statements for various types of businesses, that is according to the syllabus. So when we talk about a bank is any institution that deals or proposes to carry out banking services. So the main source of income for banking institutions are interest on the loans given to customers. I think you know that. So we have key terms like placement, which means that interbank borrowing. So that is the amount a bank rents to another bank. They are known as overnight lendings. Then we have another terminology which concerns of balance sheet items. So these are transactions which take place in the bank and are not supposed to be recorded in the book of accounts of the bank. So they include rate of credit guarantee, and forward contract. So this is one word. So rate of credit guarantee and forward contract. So we have rate of credit guarantees and forward contracts. Then we have legal provisions in the banking sector. So the use of name bank is prohibited in law unless sufficient license has been issued. So you can't use the name bank as if it's your own name. So it has to be, you have to be licensed to operate a bank, to use even the name bank. So a bank should not declare dividends until sufficient provision for bad and doubtful debts have been made. Then obviously the books we prepare is the income statement, or we call it P&L, profit and loss account, the statement of financial position. That is what was required anyway, and that is what will be required to do in any exam scenario where you have a banking question. So income statements format, we have this is the format, how you are supposed to classify anyway. Because this is just an example. Now you are supposed to do the income statement. You start from interest income. So interest on loans to customers. So remember that once the bank gives loans to customers, like now KCB Limited has given a loan to customers, it will receive interest in return. So that is an income. So interest on placement to other banks. So interest on placement. Placement can be to other banks or due from other banks. So for it to be an income, it must be interest on placement to other banks. Then interest on government securities. So that are some of the incomes. Then we have expenses, interest expenses, like interest on customer savings. Because now the money, like now you are a client, the money you want deposit in a bank, it's not a bank's asset. Customer deposits for the bank, that is a liability to the bank. That is why now the bank will give out interest. So if you have saved money in the savings account, remember that your money attracts some interest for a certain period as agreed with the bank. So the interest on customer savings, so that is an expense to the bank. Then interest on placement due from other banks. So due from other banks. So remember that in some scenarios, some other banks can rent money to another bank. Let's say we are a KCB, NIC Bank rents money to KCB. So KCB, if KCB is the one which is preparing the books, KCB would be paying an interest on the money which was which he received from NIC. Then we talk about so after that we got net interest income. So that is after you have taken interest income, you have subtracted interest expenses. Then we have fees and commission income. So these are some of the non-interest incomes. So those are some of the non-interest incomes. So non-interest incomes. So anyway, this is not the total, but this is what is given down here. This is what is given down here. So the total up there anyway is a different thing. Anyway, this is fine. So we move to non-interest incomes. So I disqualify this that I say that the total of the two is net interest income. That is wrong. So after taking your interest income and interest expenses, obviously you get net. That is a net. That is gross. You get a gross interest income. So after taking the two, so this is supposed to be a gross interest. So gross interest income. Then after that, you add some interest, which does not attract. So these are about non-interest. We talk about non-interest. So the ones which are following there is non-interest. So the non-interest. So we talk about non-interest income. So non-interest income, these are incomes which does not attract interest. Like now fees and commission income, things like investment income, or other incomes. Or other incomes. So that's all about non-interest incomes. So non-interest incomes. Then we have non-interest expense. So you raise that one, non-interest expenses. So for the non-interest expenses, again, these are some of the expenses which does not attract. The expenses which does not attract income, which does not attract interest, sorry. So the expenses which does not attract interest. So expenses like fees and commission, expenses, not income. So these are fees and commission, expenses. Then we have administrative expenses and some other expenses specified. And then after that, you get your net profit or loss for the year. So for you to understand anyway more about this topic of banking, let us do that question of rust sitting. Let us do this question for rust sitting. So this was the question. This was the question. So it was all about understanding where does this go? Where does this item go? Because they never gave you any additional information. So the foreign balances were extracted from the financial records of Savannah Commercial Bank for the end at 1st December 2020. So we have intangible assets. Intangible asset, that is an asset. Property, plant, and equipment is an asset. Interest on loans and advances, that is interest. Income. Then we have interest on customer deposits, that is an interest expense. We have loans and loan loss reserve, that is an equity item. Customer deposits are liability. Deposit and placement due from other banks, that is a liability. Because obvious, customer deposits are liability. The money which customers deposit to the bank, like now customers deposit the money in Savannah Commercial Bank. So that is not the money for commercial bank, it's the money for customers. So that is a liability. We have deposit and placement due from other banks. Other banks gave us deposits or some loans. Placements, I just explained. Placement is all about interbank borrowings. So we received from other banks. So that is not our money. That is the money we need to give out. That is a liability. Then we have interest received on deposit and placement with other banks. That is an interest income. Interest paid on deposit and placement from other bank. So interest paid, interest expense. Income tax credit, anyway, that one is concerning tax. Ordinary share capital, that is an equity item. Revaluation reserve, equity item. Depreciation on property, plant, and equipment, that is just an expense, that is non-interest expense to be more specific. Other interest income, non-interest income. Equity investment, that is an equity investment anyway, that is an asset, or it's supposed to be, that is equity investment. So equity investment, that is an asset. Then we have loans and advances. Loans and advances, that is an asset. Because now the loans, the bank advances to customers, that is an asset to the bank. That was an asset to the bank because that is the money it expects to receive. Retained earnings, that is an equity item. Deposit and placement due to other banks, that is an asset because now we make deposits. Savannah Bank made deposits and it expects to receive. Long-term borrowings, that is a liability. Other interest expenses, that is just an expense, that is an interest expense. Fees and commission income, that is a non-interest income. Dividend income, that is a non-interest income. Share premium, equity item. Staff remuneration expense, non-interest expense. Pension cost, non-interest expense. Director salaries, non-interest expense. Printing and stationery, non-interest expense. Deferred tax asset, that is an asset. Tax refundable asset. Cash in hand and with cash in hand and with central bank asset. Miscellaneous expenses, that is a non-interest expense. And that is all about the question. Once you are capable of doing that, to identify where every item could have been recorded, it could be an easy job for us to just record, and you get your 16 marks. I think it was around 16 marks. Very easy, direct, to the point. So then the other question which was very easy is that of group accounting. And then the other one is concerning partnership, conversion of a partnership to a limited company. It was a copy paste from May 2014, which I have already done in my YouTube. So anyway, let's start with this one because it will be just recording once I have classified that way. So we talk about Savannah Commercial Bank. So PLC. So income statement. So for the year ended, that is 31st December 2020. So we start with interest income. So for the interest income, we talk about interest. As per the question, that is, there was interest on loans and advances to customers. So that is 132. So it was 1.329750. Then we have interest received. Interest received on deposits and the placement. With other banks. So this is 19,780. So those were the two interest incomes. So you take 132, 9750 plus 19,780. So we get 1349,530. Then after that, you talk about interest expenses. So for the interest expenses, we have interest on customer deposits. So because I've said that once customer deposits or saves money with the bank, so if it's for example now savings it has meant. So remember that the interest which is paid is an expense to the bank. So customer deposits are not assets to the bank, but they are liabilities. So interest on customer deposits. So the interest on customer deposit, that is 750, 135. Then we have interest paid. Interest paid on deposits and the placements. From other banks. So it's all about 263. That is 26,320. And this one was 750, 135. So those are the two interest expenses according to the question. So 750, 135 plus 26,320. So I get 776, 445. So 776. So 776, 455. So I have to subtract from interest income to get net interest income. So net interest income. So for the net interest income, so I will take my 1349,530 minus 776, 455. So that is 573,075. So 573,075. Then after that, now we talk about non-interest income. So you add that. So this one you raise, then you add non-interest income. So non-interest income is just the incomes which does not attract interest, the income, so it does not attract the interest. So non-interest income, we have other interest income. According to the question, that is other interest income. So for the other interest income, that is 7760. And we have fees and the commission income. Fees and commission income. So fees and commission income, that is 13,150. Then we have dividend income. So for the dividend income, that is 2250. So we can compute. So we have 7760 plus 13,150 plus 2250. So we are getting 16. So that one we need to confirm again. So the first one we had done a mistake. So it was supposed to be 77. So we did a mistake. So 7760. We add 13,150. We add 2250. So that is 23,160. 23,160. So this is 23. So 23,160. So 23,160. So that you get total. Yeah, you get the total gross income. So total gross income. So 573, 075. So you add with 23,160. So you are getting 596, 235. 596. That is 235, 235. So then after that, we talk about non-interest expenses. Non-interest expenses. So non-interest expenses. So there we have shillings and shillings here. So we can make it a bit, so shillings and shillings there. So we talk about non-interest expenses. So for the non-interest expenses, we talk about other interest expenses. So for the other interest expenses, we have 33,700. Then we have depreciation on PPE. So depreciation on PPE is all about 62,355. Then we have staff remuneration. Staff remuneration expenses. So for the staff remuneration expenses, that is 478,710. Then we have pension cost. I'm just moving with speed because already I had classified them when we started the question. Then we talk about directors' salaries. So for the director salaries, that is 38,260. Then we talk about printing and stationery. So printing and stationery, we have 52,500. Then we have miscellaneous. I remember this one was the last one. So miscellaneous expenses. So miscellaneous expenses, that is 3,400. I think these items, this is where I'm picking the items from. That is from the question itself. These are the items. So it was just classification from this question. So if you can check on that question, which was done last sitting, you can see those figures. They are just direct from the question. Just direct. It was just classification anyway. So those are some of the, these are some of the non-interest expenses. So non-interest expenses, we have to subtract. So we talk about non-interest expenses. So if I add my non-interest expenses, I'm getting 754, 855. That is 754, 754, 855. That is 855. So you subtract. So you subtract from your total gross income. So if you take 596, 235 minus the answer. So I'm getting a loss of 158, 620. So that is a profit stroke loss after tax. So profit stroke loss after tax. So after tax or before, this is before tax anyway. This is not after tax, but before tax. So that is profit or loss before tax. So 158, that is 620. So this was a loss, of which you need to raise income tax. But in the question, there was a credit. It was not a tax, but they gave us, what they provided in this question was an income tax credit. So that one you add back. So income tax credit. So income tax credit. So there was an income tax credit. So income tax credit of 28,720. So if I add to my answer 28,720, I'm getting 129,900. So again, it's a loss. That is profit or loss after tax. So after that, remember that we could have subtracted dividends paid. So yeah, if there was dividends, but dividends cannot be paid if we have a loss. That is why even there was no dividends paid in the question. So dividend paid or proposed. So there was none, and that in real sense you cannot pay when you have a loan. Then after that, we need to add what we retained. So retained profit, or we call it an earning. Retained profit. So retained profit is all about. So retained profit for the year. So retained profit for the year from the question, that is retained profit from the previous year. This item is just given again. So the retained profit, so was it there? Yes, you can see they have given retained earnings 1st January 2020, 193,200, 193,200. So the 193,200, that is from the previous year. So this one you add to the profit or loss you are getting for the year. So that we have the retained profit balance carried down. So these are about now the one you are supposed to put forward for the next financial year 2021. So if I take my answer, you add with 193,200, I'm getting 63,300. 63,300. So that is 63,300. So that is fine. That is what you are supposed to do for the income statement. Then we move to the next part of the question. We move to the next part of the question, which concerns a statement of a financial position. Statement of financial position. So again, under banking, we talk about the statement of financial position. It's just an easy thing because now here you don't have to struggle talking about non-current assets and current. You just list all the assets together. Then you talk about equity. Then you talk about liabilities, and that's all. So I think you did that, and I never panic that if you never did that. This is just an easy question. That is why I've just chosen that, of which I mean that everybody did that because it's part of a very easy question for this setting. So we have Savannah Commercial Bank. That is PRC. Then we talk about statement of financial position. So that is as at 31st December 2020. So it's all about classification, as I have said, the assets. So according to the question, we have property, plant, and equipment. So the PPE. So the PPE, according to the question, the figure was, so this one is given anyway. When you would be revising this question, follow with the relevant question. Like now, PPE is 1,494,190. Intangible assets 857,140. So it's just classification of those items. So I will be classifying because I have the copy part of the question. So we talk about property, plant, and equipment. So that is 1,494,190. Then we have the first one, the intangible assets. I could have started with the intangible assets anyway. So intangible assets, 857,140. You talk about deposits and placements. Deposits and placements. Due from or due to? That is due from other banks. Because let's say now you gave money to another bank or you deposited, you expect that money back. So that is an asset to you. It was 389,190. Then we have loans and reserves. So not loans and reserves, loans and advances. Reserves is an equity. It cannot be an asset. So we have 367. So that is around 3,675,230. Then we have a deferred tax. Deferred tax asset, that is an asset. That is 7,500. Then we have tax refundable. So the tax refundable is all about the 27,750. Then we have cash in hand. Cash in hand and with central bank. Cash in hand and with central bank. So this one concerns 2,055,125. Then we have equity investments. So equity investments, that is 225,000. And those are some of the assets which were there. So we have total assets. Then we talk about equity and liabilities. So for the equities and liabilities, we have ordinary share capital. So for the ordinary share capital, that is 1,900,000. We have a revaluation surplus. That is 300,000. Then we have share premium. So for the share premium, that is 270,000. Then we talk about loan loss reserve. There was a loan loss reserve. There was amount they were put aside together for the losses they would incur in terms of the loans they were giving out. So that is 578,345. This is what I was forgetting. Then now you talk about the retained profit. We talk about the retained profit. So the retained profit is the one we got from our income statement, the last item down there. So the 63,300. The 63,300. So after that, we talk about liabilities. Again, you classify them together. So you don't have to talk about non-current and current liability. It's just classification of the liabilities. So customer deposits, remember this is not the money for the bank, it's a liability. Because now when you deposit any money with the bank, remember that you can withdraw anytime. So that is a liability to the bank. So customer deposits, so 3,444,990 shillings. Then we talk about deposits and placements. Deposits and placements due to other banks. Due to other banks. So other banks gave money to Savannah. So Savannah has to pay. So that is now due to other banks. So it has to pay. So which is 484, 490. Then the last thing we have long-term borrowings. Long-term borrowings. So long-term borrowings, that is 1720, that is 1,720,000. So that is all about this question. So total equity. So total equity and liabilities. So let us balance the question. So 1494, 190. That is all about 1494, 190 plus 857, 140 plus 389, 190 plus 3,675, 230 plus 37, 500 plus 27, 750. Plus 2,055, 125 plus 225,000. So I'm getting the first one for the asset is 8761, 125. So this one is 8761, 125. So let's check if it's balancing with the equities and liabilities. So 1 million plus 300,000 plus 270,000 plus 7, that is 578, 345 plus 63,300 plus 3,400,000, that is 4,990,000. That is 3,404. That is 3,444,990 shillings plus 484, 490. Then plus 1,720,000. So you can see it's balancing 8761, 125. So within the shortest time possible, you are capable of getting those marks. So the entire marks for that question. So it's all about classification. For the income statement, talk about interest expense, interest income. Talk about non-interest expenses, non-interest income. About the statement of financial position, talk about assets, then talk about equities and liabilities. And that is how simple the question was. And it was around, if it was not 12, it was 16. Around 16 marks there. Then there was another question here, the one for group accounting. So you can see you could have done this paper within the short time, even 2 hours, you are passed. And check again for the statements of, that is question 5, the consolidation question. So on 1st April 2018, Ambassador Limited acquired the foreign investments. So I want to explain what it means. So like now the first one, so I want to interpret this question of consolidation, even if I will not be doing it specifically today. So on 1st April 2018, Ambassador Limited acquired the foreign investments. So he acquired 1,320,000 equity shares in Rudisha at a cost of 27,300 when the retained earnings of Rudisha were 12,500. So remember that here, the only thing the examiner has challenged you is that he has not given you the percentage of control which Ambassa was controlling in Rudisha, but he has told you the shares which were acquired. To get that percentage is very easy. So you check those shares. So right now, the shares which he acquired is 1320. So I'm reducing this one to thousands because this statement of financial position is in terms of thousands. So in order to get the percentage, check the ordinary share capital. So the ordinary share capital here for the column of Rudisha is 16,500. So to get this percentage of control of Ambassa in Rudisha, you take the 1320, you divide with the number of shares which were here, because the ordinary share capital per share is 10. The capital is 16,500. So you take 16,500 divided by 10, you get 1650 shares. So the number of shares which you acquired as given at the start of the question is 1320. So take 1320. So you get the percentage. To get the percentage, you take the 1320, you divide by with the 1650 times 100%. That is how you could have known Ambassa controls which percentage in Rudisha. So 1320 divided by 1650. So that is 0.8, which means that times 100, this is an 80% controlled subsidiary. So which means that Ambassa controls Rudisha up to 80%. Then after that, you were told there was this again, he acquired 50% of Rudisha's 12% debenture. So that one, it cannot affect you anyway. But when I would be recording my 12% debenture, I will take a parent because I have known now Ambassa is the parent, the 8,200 plus 2,800 minus. So the 50% of 2,800, because that was part of the investment. Additional information. Number one, the fair value of Rudisha's limited assets at the date of acquisition was equal to their carrying amount, except for an item of plant which had a fair value of 1.6 in excess of the carrying value. The plant had a remaining useful life of 4 years. That is very simple. That is concerns revaluation. We know that the revaluation, when I talk about revaluation is the difference. Is the difference between what? Between the carrying amount of an asset and so is the difference between the carrying amount of an asset and the fair value or we call it market value. So the difference between the two. So in some scenarios, they will say that they will give you the revaluation direct by saying that the fair value was in excess of. So sometimes they will say that the fair value is in excess of the book value by a certain figure, or they can say the book value is below. Book value is below the fair value by a certain value. So the way they have provided in additional information number one, the way they provided in this additional information number one. So where is that question? So as they are provided in this question, which I will share. So the question is here. So that is fine. So they say the fair value of the Rudisha's assets as at the date of acquisition was equal to the carrying value except an item of plant. You can see that at a fair value of 1.6 in excess of the carrying amount. So the way I've said, so 1.6 is revaluation. So with the revaluation, what you do, debit PP, you credit the revaluation reserve account. But now to avoid a lot of double entries, you just add to the PPE. So what you could have done when you were recording your PPE, when you could have done your consolidation of this PPE, you see this PPE, property, plant, and equipment. Remember that the first one, see, I could have taken 37,300 plus 24,060 plus the revaluation. That is what I mean, debit PPE plus that 1.6. Then other than that, so for the accounting purposes, revaluation, for the revaluation, you do what? Debit, group PPA, so group PPA account, then credit, revaluation reserve. Revaluation reserve account. So, but now for my case, when I do the question, I just do it direct. And with this, just for your understanding, for the interpretation. So revaluation again leads to depreciation under charge. So due to this revaluation, it leads to what? It leads to depreciation under charge. It leads to depreciation under charge. Because you will find that now the asset has increased. The plant, for example, now has increased by the figure of 1.6 as provided in the question. So which means that this 1.6 has not been subjected to depreciation. So we need to check the depreciation which is inside the 1.6. Because the asset has increased in value, and that figure by which the asset has increased has not been depreciated, has not been subjected to depreciation. That's why we say that the plant, the relevant asset, has been undercharged. So that is why the examiner went ahead to give you the relevant time, the remaining life. After giving you the revaluation of 1.6, the examiner went ahead to say that the plant had a remaining useful life of 4 years. So you could have taken 1.4, not 1.4, but 1.6 divided by 4. 1.6 divided by 4. And the best thing for this question, it was a full year subsidiary because it was acquired when this subsidiary was acquired. So that is what I forgot to talk about at the start of the question anyway. But you always have to check for that. So our financial year ends on, as per the requirement, 31st March 2020. So which means that it starts 1st April 2018. And that is the time when the subsidiary was acquired, 1st April 2018. 1st April. So it was even acquired in 2018. No? So our financial year ends 31st March 2020. Sorry for that. So our financial year ends 31st March 2020. So our financial year starts 1st April 2019. And you can see that the subsidiary was acquired 2018, which means that in 2019 it was there for the full year. That is fine. That is fine. But this revaluation occurred when? Did they give us the date? So anyway, this is during the year. So it was during the year. So it doesn't, the timing doesn't affect us in any way. So which means that I was talking about depreciation under charge, which will take 1,600 divided by 4. So you get a 400. So the 400, what you do to the 400, you debit retained earnings. You debit the retained earnings, you credit group PPA. Because now you have to subtract under the group PPA. You have to subtract under the group PPA. Because after adding revaluation, minus group PPA. That is how I will do the question. So I will take the parent plus the subsidiary, I will add revaluation of 1600. I will minus 400. That is the direct way. For your understanding, debits, retained earnings, group PP. But you know, under group PP, the PP, the first item in the question, you minus these 400. So after that, we are done with the first additional information. Then the second additional information concerns on 15 March 2020, Rudisha sold goods to Ambassador Limited for 700,000, or on credit terms, the goods had not been received by the company as at 31st March 2020. So it means that they were on transit. So those are goods on transit and they were on credit and they were not included in the closing inventory. So no entry had been made in the books of Ambassador in respect of the transaction. So Rudisha sells goods to all customers at a standard markup of 16 2/3. So there's something which I missed here when I was typing this question. So it's 16 2/3. 16 2/3. How are you supposed to deal with this? It's very simple thing. You record these goods to you on credit. So Ambassador will record them. So they were goods on transit. So once they will come, you will debit the inventory. And then after debiting the inventory, you have to increase the payables. So add inventory. So you have to add the inventory and you add it to your payables. So when you will be consolidating the two, that is inventory, you increase by 700. Payables, that is trade payables, increased by 700 because these goods were on credit and they had not been received by the other entity. So that's why I need to increase my inventory as Ambassador. Again, I have to increase my trade payables because they were on credit. So again, you have to check for the unrealized profit on stock because obviously the Ambassador, yes, will receive them on a later date, which means that when Rudisha sold them, he sold them at a profit of 16 2/3. So we have to check the profit which Rudisha realized, but Ambassador never realized because Ambassador never resold these goods. Because even he never received them at the end of the year. So that one, it has to be minused from our inventory account, though the unrealized profit on stock, whereby you check the unsold goods, which is the total 700 times the profit margin. The profit margin. So the only challenge which was there maybe was on how to change this 16 and 2/3. So 16 times 3, that is 48, then 48, that is 50 out of 3. These are percentage of 100%. So it's like saying 50 out of 3 times 1 over 100. So these are reciprocal. This is like over 1, that is 100 over 1. That is why I'm taking it on the other side to be a reciprocal. Then you take 50 over 300. So 50 divided by, that is 1 over 6. So this is again markup. So 1 over 6 markup, to change it to margin, you add the 1. Numerator to the denominator, you get 1 over 7. So to get your UPS, unsold goods is the total 700 times a margin of 1 over 7. So which means that the UPS was 100. The UPS was 100. So the 100 will be subtracted under inventory. Then 700 you add under inventory and you add under trade payables. The next thing, number 3, as at 1st March, the accounts payables of Ambassador included 750 due to Rudisha before taking into account the above transaction. So these are about the intergroup owings. And we know that the intergroup owings, you forgo this amount. So when there's an amount which is outstanding between the two entities, parent and subsidiary, and which has not been settled by the end of the year, so you don't have to carry forward the amount to the next financial year. Like now in this scenario, as at 1st March 2020, the accounts payables of Ambassador included 750 due to Rudisha. So this amount has not been paid. So we forgo. To forgo, you adjust two accounts. You adjust the trade receivables and trade payables. You subtract both sides. Subtracting under trade receivables, you have credited. Subtracting under trade payables, you have debited. So subtract both under trade receivable, under trade payables. So which means that debit trade payables, credit trade receivables. Number 4, Ambassa had not accounted for dividend receivable from Rudisha. Anyway, we are not supposed to record the income statement. We are not supposed to do that. So this number 4 is not applicable. Number 5, goodwill arising on acquisition of Rudisha was considered impaired by 20%. Once you do the goodwill, you impair the goodwill by 20%. Impairment is an expense. So anyway, for you to get the net goodwill, you have to impair the goodwill, of which you know that goodwill you either use full method or a partial method. And for you to use the full method, you have. So I'm saying that you know that goodwill. So anyway, these things like goodwill, I've done videos on my YouTube channel. So it's all about purchase consideration minus share of net assets. Share of net assets. You know that now here we have two methods to use. You either use full method or a partial. Of which for you to use full method, you must be given the fair value. You must be given the fair value of NCI according to the equation, of which once you use the fair value of the NCI, you get the goodwill of the going to the parent and to the NCI, which is the non-controlling interest, which is going to the non-controlling interest. And that is how they give you the fair value. So which means that you are supposed to use the full method. You are supposed to use the full method because the last thing they gave you is not about the fair value attributable to non-controlling interest. And that is what was required in that question. That is what was required in the question. So what I was saying that right now, Goodwill have done a very good illustration in my YouTube channel. So this is the one I have done. So if you go and search Goodwill by OCHOI, so my name is Edwin OCHOI in YouTube. So this is the relevant video I have done. So then you need to know that purchase consideration. What is a purchase consideration? So a purchase consideration is the amount paid. The amount paid. That is amount paid. Amount paid by the parent. Amount paid by the parent. So you can see that is among some of the that supposed to use to compute this. It must be measured. On my classes, I always avoid. So when I will be doing my ordinary share capital, 80% of the figure of the ordinary. So here we did an illustration at the end of this question. 80%. I think there was an illustration I did here. So negative goodwill is an income. So I have interpreted that fully. So you can go and take that. Or now to do the goodwill. Anyway, you have known that for this question, goodwill you could have done using full method. So whereby, in order to use this full method, you must be given the fair value of the NCI as given in the last addition information. So goodwill, once you get the goodwill, you have to impair. That is why they give you the impairment of 20%. So which means that the net goodwill you get after impairment, remember that positive goodwill is a non-current asset. Negative goodwill is an income. So on this night, it was a positive goodwill. So which goes to the non-current assets. So as I have interpreted all of the additional information, so what you could have been doing is all about you take the parent. So for consolidation now, the direct one. So like now the first one, you could have taken, like now PPE, let's say consolidate PPE. So you could have taken 37,300 plus 24,060 plus revaluation minus depreciation under change. That is all. There was no another thing to adjust there. For investments, you check the goodwill, because investment, you replace the investment with the goodwill. So the goodwill of that Rudisha. So using full method. For inventory, you take parent plus subsidiary. You could have added the 700. You minus the 100. The 700 is concerning the goods you want to credit. You increase that inventory, then you raise the UPS because the other entity never resold those goods. Account receivable you could have taken for the 360 plus 1950. You minus the owings, the 750, which was there. The one which was concerning addition information number. I think it's addition information number 3, the 750. You minus that. There's nothing else to minus that. For banking, it was direct. There is nothing to add because it's 1390. There was nothing to adjust there. For ordinary share capital, you take the parent only. Then retained earnings, you do a working. Then you introduce non-controlling interest, you do a working. Debentures, I already talked about it. You take 8200 plus 2800 minus the 50% of this 2800 because it was part of the acquisition. For deferred tax, it was direct. You take 3900 plus 1200. Accounts payable, you take 5710 plus 1760. You minus that. You minus the one which was outstanding, the 750. Because we forgo. Once I minus under receivables, I minus under payables. The 750. Then there was goods which were on credit. So the goods which were on credit, I need to increase my payables again. Then so which means that for the goods which were on credit, the 700, I need to add under these payables again. So I add, so under payables, you could have subtracted 750, you add the 700. Taxation direct, you add the 2. Dividends direct, you add the 2. Bank overdraft direct. And that is how you could have scored around 80% of this question without a lot of workings. For the question 3, which was concerning conversion or partnership, again, I had already done that. If you could have gone through the concept of, conversion, there was that question of conversion for May 2014, which I had already done. So the same concept, it was the same concept. So again, I can display that from my YouTube channel. I can display that one. You can see these things. If you could have used my channel well, this paper was just simple. I saw the other group saying that the paper was hard, but I don't think so. I don't think so. So let us search here conversion. Conversion of partnership to a limited company. This one. So you can see the first video which is coming is mine. So now we are doing a question of a conversion of a partnership. That is conversion of a partnership to a limited company. So this is a question of 2014 December. So they said this, that the financial year, so this is so the partners decided to convert the partnership into a limited company, Bama Limited, on 1st April 2014 under the following terms. So which means that I need to record that 1st April 2014. So 1st April. So the concepts were the same. So go through that question if you need to understand what you were supposed to do. So the concept was the same. But the better thing of this question is that we had already been given what? We had already been provided with the gross profit. We have already been provided with the gross profit. So I think you have seen that gross profit was. I want to move just slowly so that you will be getting. So the gross profit is, you can see we were given a gross profit of 33.
300. 33, and this is for.
So, but now the question of receipting, they started with sales. That is the only difference. But the other things were the same. So already we have at least checked around 3 questions, which was done in the previous sitting. So when we meet next time, I will be doing this question of group accounting until it balance. So I need you to I will give you the answer now, even if I have covered the 80% of what you are supposed to do. It's only that now we'll be recording the figures and some of the workings, like now goodwill, retained earnings, and uncontrolling interest. Those 3 in your exam, it's not even a must you do them, but you can score the 80% of the question. So I have the online classes which are ongoing for the same. That is concerning financial reporting, financial accounting, advanced financial reporting. And I have other guys for the other units, my colleagues in the accounting world. So you are welcome to subscribe because the classes are starting on Monday. That is the coming Monday. So you can subscribe to the online classes by calling me through the number of 0728 760 546. So if you want to join those classes, you can reach me through this number. So this is 6. So the 28 760 546. So that we can, in those Zoom classes is where now I cover everything concerning the syllabus from the first topic to the last one. From the first topic to the last topic. Even the theory part of the syllabus is well covered. So you are welcomed, and never forget to subscribe to this channel, and you share to your colleagues, and also welcome them to join the Zoom classes. So you can have a nice time. We meet next time when I will be doing other questions on the same channel. Thank you.